Hey YouTube family, today we're going to take a look at a whole lot of different things that are going on in the economy to see if it's a time to buy a house here in Utah. Now, if this is your first time to the YouTube channel, I'm Dinko the Realtor. I've been in the real estate game since 2016. I provide game-changing data, information, and analysis you're not going to be able to find anywhere else. So do yourself a favor, smash a subscribe button down below. That way you're up to date with what's going on in the housing market for 2023. Now let's take a look at this article right here by usnews.com. Meltdown in Deutsche Bank shares shows banking crisis is not yet over. And if we go over to the CNBC article, the Swiss claim that the US banking crisis ultimately toppled Credit Suisse. Now, Credit Suisse is an investment banking giant, and they were potentially on the verge of collapsing after Silicon Valley Bank. The Swiss government said they were going to get behind them, and they ended up actually selling out, merging with a competitor out of London. And right here, if we go over to the article by US News again, we see that Deutsche Bank, the German mega bank, saw the costs of insuring its bonds against default soar amid a growing global banking crisis. The key words here are growing global banking crisis. Now, I've been hearing some people stating that interest rates going down 0.5% is signaling that it's the time to buy and that prices have stabilized. The fact that interest rates have gone down 0.5% because we're on the verge of a global banking crisis is not an indicator that it's a good time to buy, because if the financial system fails, unemployment is going to skyrocket, foreclosures are going to skyrocket, businesses are going to have a hard time getting loans, and they're going to be going out of business. The fact that we're potentially having a banking crisis is not a good thing for real estate. I don't know where that came from. That is not signaling that it's a good time to buy. Now, I'm going to show you an article that Jerome Powell is signaling that we are going to have a recession here, and also Indeed is not really that optimistic about the job market, and they're actually doing layoffs. So I'll show you those articles as well, but real quick, before we do that, if you're looking to buy a house anywhere in Utah, remember Dinko the Realtor has your back, and I specialize in helping people along the entire Wasatch Front, the greater Salt Lake area. My contact information is down below in the description. Now, if we take a look at this article right here, the Fed Chair Jerome Powell, touted as the guide to economic troubles, says a recession and rate cuts are coming this year. They would do rate cuts because they no longer have to increase the rate because they've already done their job of taming inflation. Well, they're now indicating that a recession is much more likely, and he was not really saying that they were going to do a soft landing like he was before. Well, if a recession does happen, we know that will cause unemployment to go up. Is that an indicator that it's a time to buy? Probably not. So, I mean, we're just going to keep going through all of this. I got a whole lot of different articles and a lot of different information. For that, do me a favor, smash that like button down below. Help me grow the YouTube channel. Right here, Austin-based job site Indeed announces 2,200 layoffs worldwide. This is an article from the Austin American Statesman. Now, if we scroll down here, and their headquarters are in Austin and in Connecticut. So they have two headquarters. And right here, if we take a look, they're laying off 2,200 employees, roughly 15% of its global team. So this is not going to be just one area. It's going to be global layoffs that they're doing. And their CEO even took a pay cut of 25%, the article states right here. And then if we go down here, this is the big kicker right here. And I'm not sure if I'm pronouncing his name right. Hyams said it's also increasingly likely that human resources technology revenue will decline in 2023 and potentially in 2024. Indeed makes a living off of filling job vacancies for jobs, and they are not optimistic about that. And the data that they have, you would think that they would have data that the rest of us don't, because they are a leading indicator of filling these jobs and what's going on. Right here, if we take a look, openings in the United States were down 3.5% last year, or last quarter, year over year. But the sponsored jobs dropped 33%. And that's the big one, because the company makes money through sponsored job postings. And those are down 33%, which means companies are not wanting to fill those vacancies. They don't have that same urgency that they once did. Facebook, now called Meta, is doing a second round of layoffs. And they pulled 5,000 jobs that they did not fill. They just pulled them off. That is an indicator. And I've been warning about the potential tech bubble. And with the crash of Silicon Valley Bank, that potential tech bubble is only going to get bigger because the startups and the venture capitalism, where they were able to get the funding from Silicon Valley Bank, that is going to be drying up now because certain banks are not going to be lending that. And we'll get to that here in a little bit later as well with the credit crunch. Now, right here, we see that credit card debt is at an all-time high and putting households near breaking point, a study shows. And this is a CNBC article. If we go over here to a CBSnews.com article, we see that Americans, when they were hunkering down during the lockdowns, they had record savings, but then inflation, and right here, consumers racked up $180 billion in new credit card debt in 2022. That is not a good sign, is it? And if we take a look here, the largest amount of debt ever added in a single year. It only gets worse, according to a recent study from a personal finance website, WalletHub. And right here, nearly half of that total, almost $86 billion, was added in the fourth quarter, marking the biggest ever quarterly increase in credit card debt. We are seeing that this hasn't happened in 20 or 30 years. This is the first time for this, first time for that. All of that is not indicating that the housing market has stabilized. Housing is always the last thing that gets impacted because people need a place to live. And right now, nothing has fully popped off, and yet we have seen double-digit declines in home prices nationwide, and the median price nationwide is negative finally year over year. That is not indicating that things are stabilizing. So if we take a look at this next article, and we went over this in the previous video, but real quick, amid the bank sector woes, concerns mount about finances drying up for the home builders and home buyers. Right here, we went over this as well, so I'm going to go really quickly. We see that these loans, per the Scotsman Guide, are short-term in nature, typically lasting anywhere from 6 months to 3 years. Well, a lot of these builders are going to have to refinance. And check out this credit crunch. This right here is what's going to have a whole lot of impact on that. What happens during a credit crunch, and how can you prepare for one? Well, a credit crunch is a significant tightening of lending standards among banks. Loans are harder to get and become more costly. Well, if that's the case, and home builders right here are going to have their finances drying up, and their loans are typically 6 months to 3 years. Well, if their loans are 6 months to 3 years and they can't refinance it, they thought they were going to sell their subdivision much quicker, and now they're holding on to that inventory, hoping that those spring buyers are going to save them. Well, sooner or later, they're going to have to refinance, and their interest rates are going to be higher. So that's not going to make a whole lot more sense if they're even able to get a loan. Or because of that credit crunch, they're not even going to be able to get a loan because banks are going to be tightening and saying, hey, that's too risky. Now, they're going to either default, or they're going to have to be forced to liquidate those assets, the homes that they have built, and sell them, drop those prices again, just like they did at the beginning of the year by $100,000, drop them again, and get that stuff liquidated so that they don't default. And if they do, the bank is not in the business of selling houses. They're going to sell that loan to another builder. Now that builder is going to have bigger margins because they're going to buy it at a lower price, and then they can go out and sell those homes, complete the rest of the subdivision. That's why we have to pay attention to everything that's going on. And again, you're not going to get this information anywhere else. Do me that favor, smash that like button, help me grow the YouTube channel, and let's go through some of this data here really quickly. We're almost done here. Commercial real estate is in trouble, and a banking crisis will make it worse. Not only do we have a well, that's actually next, but not only do we have a housing crisis. Well, let me just go to the article and I'll come back to the real estate, commercial real estate here. Car payments push Americans closer to financial edge, with severe delinquency rate the highest in 17 years. Right now, we're in 2023. You would have to go back to 2006, according to that article here by Fortune. And that means we have more delinquencies right now than we did in 08, 09 on the car loans. Well, cars are kind of resemblance of the 08, 09 housing crisis, where there's a lot of subprime car loans out there. Cars are not an appreciating asset. And during the pandemic, a lot of these cars went up in value by 50, 70%, and people bought these cars. Well, that's a depreciating asset. Now, banks are holding onto a loan on a car that's not worth that, and it's only going to depreciate. A car gets older, again, it depreciates. When somebody gets in a car accident, they're going to have, unless they have gap insurance, they're going to have to make up that difference. When that car gets repossessed, again, they're going to be selling it at a discount, and then they can go after the borrower and say, hey, you still owe us money on that. See how all of this stuff can be spinning? Yeah, this isn't like 2008, 2009. And it doesn't have to be that bad. However, we have way more dominoes right now. So potentially it could be 2008, 2009 if these dominoes start falling, because we had a financial crisis in America that caused a global recession. Well, right now we have a global banking crisis. Isn't that potentially going to be worse? Now, this is the commercial one. So commercial real estate is in trouble. This is a Yahoo article. And if we take a look at this right here, if we go down, we see that giving the landlords even less room to breathe as they are trying to refinance a mountain of loans that are coming due. This year, roughly 270 billion in commercial mortgages held by banks are set to expire. And if we go down here, there were already liquidity issues. There were fewer deals getting done. Xander Schneider, First American senior commercial real estate economist, told Yahoo Financing in an interview, access to capital was getting scarcer, and this banking crisis is almost certainly going to compound that. Now we have a commercial real estate crisis, which means if people start defaulting on these loans and businesses start failing because they can't pay the rent, they can't refinance it, this loan is coming due, whatever it is, that is potentially going to increase the unemployment rate. That is also going to impact housing. Interest rates going down 0.5% because we are having a financial crisis nationwide and globally is not an indicator that it's the time to buy. You're not going to get this information anywhere else, so do yourself a favor, subscribe down below, that way you're notified when new videos drop. Do me a favor, smash that like button again, that way you help me grow the YouTube channel. Remember, Dinko the Realtor has your back anywhere in Utah, and my contact information is down below in the description.